Hello, everybody. We are going to start up here in a little bit. Our tax planning, building financial well-being in 2024 and beyond, our tax planning guide and tax planning webinar. So we're going to let a few people join us that are coming in here right at 1 o'clock, and then we'll get going in a few minutes. Look forward to sharing some education with you and taking your questions and providing some answers in the next 45 minutes.
Okay, so it looks like we got some attendees jumping in, so we will get started here. So welcome to 360 Financial's year-end tax planning webinar. We're delighted to have you with us today. In this session, we'll dive into the essentials of 2024 year-end tax planning and how to make a real difference in managing your assets. I'm Will Grant, a certified financial planner and certified private wealth advisor and a wealth advisor here at 360 Financial. So on today's agenda, we will explore the importance of year-end tax planning and a few things to consider before this year wraps up. So on today's panel, we have our experts on tax strategies, investments, retirement, and risk management. So we have Joe Rapacki, CPA. He is the founder of Rapacki & Company, a firm based in Edina. Joe has a strong interest in taxation issues. He brings to the table a deep understanding of the intricacies and challenging nature of the financial scene. We have Mike Rogers, the president and founder of 360 Financial. As a fiduciary, he utilizes his 30-plus years of experience to orchestrate and implement customized strategies specifically tailored to address the issues and concerns of qualified retirement plan trustees, high-level professionals, and thriving business owners. We also have Brian Bonzak, Senior Vice President of 360 Financial, Financial Advisor, and Managing Principal of the Elk River office. Brian specializes in risk management, including life and health insurance. With all these professionals on hand, we'll also have a Q&A at the end to address any questions. Please add them to the chat or Q&A section as they come up, and we will address them. We will also record this webinar and send it as a follow-up to all attendees. Also, if you'd like to learn more about 360 Financial in our Life Wealth Plan process, we will make sure to stick around to the end of the webinar for a few more minutes. Mike and Joe will dive into the critical role of tax planning in achieving financial well-being, emphasizing the need to review current and projected income, optimize timing, and adhere to tax laws. Now I'll turn it over to Mike Rogers. Take it away, Mike, Joe, and Brian.
Thank you, Will. Thanks for that introduction. So participants that have joined us, thank you for spending a little bit of time of your day learning more about this issue around taxation. You know, we firmly believe that tax planning is essential to create wealth. Tax planning is essential in the financial planning process, and it's essential to really kind of leave this legacy for your family that you took advantage of many tax situations and codes as you possibly can. So it's an exciting topic for us to bring because we do get excited about saving our clients on taxes. The one thing and the reason we're doing it here in October is we don't want you to wait too long to plan. And so Joe's shaking his head up and down, and this is going to be a conversational webinar. But, you know, when you show up in Joe's office, and Joe is his firm is basically a subsidiary of ours. We have an equity ownership in Joe's office, and we think it's vital to have this partnership between your tax practice and your wealth management practice. And that's why we have this arrangement set up. But Joe and I have talked about in the past, when people show up in January, February, March, April 14th to get their taxes completed, the planning opportunities have mostly disappeared, haven't they, Joe?
Yeah. Some still remain in early 2025, but some things go away. So it's important to check in before year end if something's different, or if you think you might be able to do something to minimize your taxes for 2024. So.
Yeah, 100%. So if it's a situation where we're in we're looking at trying to plan for next year and it's October, this is a perfect opportunity to spend a little time doing that. So again, good on you for joining us for this webinar. This is going to be some real timely information. We also know that everybody's unique and everybody's got a little different situation. So we're not trying to be everything to everybody in this webinar, but just give you the foundation for some good ideas, and then talk to your respective wealth manager, whether it's Will or Brian, or your tax advisor, whether it's Joe or somebody else, to basically make sure that you're, addressing these issues before December 31st. So, a few things you're going to want to look at, for this year as we get ready for this planning, is looking at, your income, and try to review any projections as far as where your income might be for the rest of the year, looking at tax brackets and looking at potentially your Medicare premiums and those tax brackets that are associated with that if you're 65 and older. So let's as a group, and again, everybody in the panel, just jump in when you find something that we need to go a little bit deeper in or a little bit more clarity around. But I think the very first thing we want to take a look at is, what are we actually looking at for tax rates? And so what you'll see here is this real simple chart that we put together. We got the source here from NerdWallet, but basically it just takes the federal income tax brackets, breaks it down into single taxpayers and married filing jointly, married filing separately, and then head of household. You'll see there's really no difference between single and head of households on this chart. And so a lot of our clients fall into place or in the single category or in the married filing jointly category. And these tax rates are based on the dollar amounts that you see in that band of income is what you pay for taxes. And so as you climb up further, as an example, you go from $94,300 to $201,000, right smack in the middle of this tax at the 24% bracket, and so on when we're looking at the married filing jointly returns. Okay. When we look at the Minnesota, and most of you that are on this webinar are Minnesota residents, or at least you were at one time, because we have a large number of clients on this for an education purposes, and we have a lot of people that are just new to 360 that are learning a little bit about our way of working with our clients. But most of the time, we find that the Minnesota tax rates apply to most of our clients. And so obviously, we have a tax rate on income here in Minnesota, and if you look at the married joint column over there on the left, give you some idea when you make over $184,041, for example, everything above that is taxed at the Minnesota level at 7.85%. Okay, and obviously increases to 9.85 when you hit 321,000. So these are income tax brackets. Joe and or Brian, anything around, and we have a chart here later, but around capital gains and kind of how they're taxed differently than income taxes at both the federal and the state level.
Well, yeah, the state does not have separate brackets, so to speak, for capital gains. It's only the federal government does.
Yep.
So, and most clients are falling into the 15% capital gains bracket that we run across. Yeah,
Could go as high as 20%, right, on the federal side, Joe. And obviously it can go as high as 23, really, can it?
You can, definitely, yeah.
Mm-hmm.
So,
So the for the tax rate scheduling, this is strictly income, and as Joe mentioned, since we don't have a capital gain rate here in Minnesota, any capital gains that you receive throughout the course of the year fall into your kind of income tax brackets.
Yeah.
So real important for us to plan around these brackets. That's today's webinar, and how do we try to take advantage of the lower tax brackets if possible, and what strategies should we use in order to get us to those.
Yeah.
So when we start looking at a few things that are important, and Joe, I know you see this when you're working with a lot of a lot of the clients, just reviewing maybe here in October, how much you're withholding and what you've been paying for estimated taxes this past year.
Yeah, we're definitely doing that now. People are sending us their year-to-date pay stub to see if how it compares to the prior year, and also if they have any other income, dividends, interest, capital gains, how that might affect them for 2024. So, yeah, it's the perfect time of year to start doing that.
Yeah.
So, Joe, a lot of people have part-time jobs. Does that impact their overall withholdings? Do they have to kind of look at both their primary job and then their part-time job and see how that looks together?
Yeah, definitely. Yeah. A lot of times the part-time jobs, they tend not to withhold very much federal or state income tax, and that it can mess them up. Come tax time, you're going to have a tax bill. That's an unpleasant surprise. So yeah, part-time jobs, especially if somebody has multiple part-time jobs, then it becomes they usually they're underpaying for the year.
Yep.
And
find that
Joe,
very true, Joe. Yep.
Yeah.
And would you say that now is a good time to review it, as it is October, so that you would have time to make any withholding adjustments before the end of the year, as opposed to waiting until December to go through this exercise, Joe?
Or even November. It's hard to change. If you have part-time jobs, it's hard to manipulate the withholding there. So estimated payments are probably the way to go for people that have multiple jobs like that.
Yeah, and I was just meeting with a client the other day, and the tax withholding, it became an issue. We talked about estimated taxes, and this client had a farm, and it was farmland that they were renting out, so they were getting income from that farmland, and so that created a situation where the estimated taxes were really crucial. And you have a tax payment in January that people need to make for estimated. And if you don't have a good idea of what your income stream is going to be for the year, it's hard to really narrow in that January 15th payment, is my experience. What do you think about that, Joe?
Oh, yeah, I agree. And it's even more important for people that are going to be traveling, people that are snowbirds, so to speak. They're going to be out of the state, and this is the time of year to kind of plan ahead a little bit, so they don't have to worry when they're out of the state and relaxing in a warmer climate or something. It's
so nobody would want to do that, right? When it's 20 below here, but that's another webinar that we have on how to change your residency if you're so inclined. But today we're talking about Minnesota taxes and federal taxes. But yes, lots of our clients are out of the area when it comes time for tax season, and they don't come back until tax season is done. So having a good handle on it before you leave for the holidays really just puts you further ahead of the game too.
Yeah, it prevents any penalties. That's another thing. You hate to have clients come back to Minnesota and have to pay penalties with their tax return if they're filing after the April 15th deadline. It does happen. So
yeah, so trying to get ahead of that to avoid those penalties makes a lot of sense, obviously, because nobody wants to pay a penalty. We pay enough in taxes without actually adding on a little bit more. Yeah. So, Will, this is something that we go through frequently in our life wealth plan, and maybe what you could just explain kind of to the people here joining us today is what are we looking at in this chart?
Yeah, this is a snapshot of our life wealth plan, especially the tax planning capabilities that we have. We go very deep too with a review of a client's tax return to highlight even more capabilities. But what the software allows us to do is to project year by year between your working years and retirement years based on your income, based on your investment portfolio, whether it's investment accounts, qualified accounts, when your required minimum distributions start, which you'll see on this graph is where that bar starts to increase in value, is that your required minimum distributions start for our retired clients. You can think of your 401k where you receive the tax deduction on the front end. Now Uncle Sam wants their piece of that. And that's where you see how we have to manage that over time as the withholding, the percentage you have to take out increases, as well as the portfolio continues to grow to cover your expenses, which increase by inflation each year. So what we do on an annual basis here is review where your taxes are in the current year, that we can do some tactical planning, but also in the forward-looking years where we can look at different tax windows, or where you start to cross different tax thresholds represented by those lines, which just represent different income tax brackets. What's also important to keep in mind is if there's any changes to the tax law, like the end of 2025 sunset, these are things that we review. And if things change from things outside of our control, then we may need to update the plan and revisit our strategies. So this is a very important tool for our clients to not only see where they are this year, but to do some forward-looking projection as well.
Will, you bring up a really good point, Brian. Maybe you can comment on it too. Is this sunsetting provision that's going to occur in 2026? At least most likely, not necessarily for certain, but most likely. Any color you can bring to that kind of conversation?
Right. In that previous slide, we saw the tax brackets that we look like for 24. They're going to be very similar in 2025. We might see some inflation indexing, but in 2026, under current law, the brackets are going to go back to where they were prior to the last tax law changes. And those are what we're seeing on that bottom. So the 12% bracket today is going to go to 15. The 22%, that bracket we saw in that previous, is going to 25. And the current bracket that we're in, 24%, is going to go to 28%. So those are the current laws. And like Will was saying, we have to put that in our plans because those are the laws that we have to go by. Now, we've been all listening to the news. We know those things could change in current Congress when Congress gets back together in 25, and they could obviously make some changes, pass some laws, see if they can get them, either continue them or they change them in the future. So we'll have to keep a close eye on that.
Yeah, and that's the great point about that is Congress does actually have to change it. I mean, it is going to sunset unless Congress steps in and makes changes. And it doesn't really matter which party you're interested in, to have win in a couple of weeks. Both parties have the reason to let it sunset. Both parties have the reason to try to change this. It really is going to depend on what kind of relationship the White House has with Congress and what kind of mandates might be able to get through. So it'll play out. But as Will pointed out, certain things we control, certain things we can't control. So we can't control what Congress does or doesn't do, but what we can definitely control is how we plan around it and try to take advantage of the situation that we have in front of us.
Yeah, and this chart also does a great job to when we help clients who are fully retired to fund their expenses. This helps us look at where those mechanics or where those specific accounts and withdrawals that we need to take advantage of. Because you may be fully retired and not have a high income anymore and be in a low tax bracket, therefore maybe a low capital gains tax bracket. So this software allows us to do all sorts of analysis to when we're in retirement, help you take out the money you need to, minimizing taxes as much as possible.
Yep. Absolutely. So with that, there's a number of things that we really want to take a look at, a little bit deeper dive as far as some year-end actions here. And we strongly recommend you don't wait till December 30th, to do these activities and try to get a handle around it. But there's really about 5 or 6 different activities, and then they kind of splinter into different activities. But, I think when we look at this, and we'll kind of go through it a little bit in detail, but, the retirement contributions and the deductions is really a big one that you can still, in most cases, take advantage of today, and so, if you qualify for an IRA account, could you make a contribution in that? Now that potentially could be done next year, but that's something to look at. Your 401k plan at work can't be, or your 403b plan, it can't be. So if you're in a situation where you can still make contributions to those accounts, you really are going to want to make sure that you're trying to maximize those. Your IRA contributions can go until April for this tax year. But again, it's something you want to look at from a cash flow perspective. If you're planning on that, talking to Joe, talking to Brian or Will or one of our other advisors and say, okay, what tax bracket am I in? And can I actually even make a deductible IRA contribution? Because, those laws obviously changed years ago, decades ago, and very few people kind of seem like they can deduct those IRAs these days. But there are other types of IRAs. There's SEP IRAs, there's Roth IRAs. So there's a number of things to take a look at. So on that side, and again, we can help kind of project what makes the most sense for you. We'll talk a little bit more about that in detail. The capital gains and losses, this is something that we're very active in right now. And, Joe, a lot of times, people show up with their 1099s from the previous year, and those 1099s will show their gains. But frequently, they could have taken advantage of maybe some losses that they had in their investments to offset some of those gains to try to bring down their overall tax rates. So
Yeah.
I would assume you see that fairly often too.
Yeah. And I also saw somebody this morning, believe it or not, somebody that hadn't rebalanced his portfolio for a number of years. Now he's stuck with all these big gains that he's trying to figure out how to handle, because he has large minimum distributions at the same time, so he let it go for too many years. Now he's going to pay a little bit higher taxes. So,
yeah. So, I mean, it's one of those kind of, good case, bad case scenarios, right? I mean, the investments went up in value, and we're seeing that especially the last couple of years. When you have a market like we had back in 2022, you might be able to do some tax loss selling, kind of take those losses, and we'll talk a little bit more about them and park them, if you will, and use them against future gains. But we have a little bit less of that going on right now, and especially somebody who's in that required minimum distribution range. Now their income has also jumped up, and that's a great case study for why it's important to do this earlier instead of waiting till you're in your 70s to try to figure out the tax situation. Will, you want to talk at all, or Brian, maybe about, charitable donations and gifting?
Yeah, you can lower your taxable income if you're itemizing your deductions still. So if you make a donation to a nonprofit, to your church, that will be able to increase your deductible, or your standard, or your deductions, your itemized deductions, to offset your income. So for anybody that's still itemizing, that's a great strategy. And if you're not itemizing, then you could also talk to us about qualified charitable distributions, which is another charitable giving strategy that might help you offset some income.
Yeah, there's charitable gifting of highly appreciated securities, donor advised funds, different, legacy vehicles. If the family is interested in acting like a foundation to do legacy gifting to charities. We also talk to clients towards the end of the year about gifting to family members, whether it's cash, and different options there to any type of gifting that meets the family's goals. So very important things to touch base on and not wait until the end of the year.
Yeah, we get really busy with these charitable donations, and we'll go a little bit deeper into all of these categories. And but it's something that you can do good for others and also get some tax benefits, and that's a pretty powerful combination if you're into our mantra of enriching lives. So that's a fun and enjoyable area to talk about with clients, and then number 4 is Roth conversions. We'll go into some detail about that, and we'll talk a little bit about some opportunities on a case study. And those are interesting, as well as the thing that Joe mentioned earlier, required minimum distributions. We all eventually face these if you have money in a 401k plan that was pre-tax, and then you have to take some money out at a certain age. So we'll talk about that, and then we'll dive a little bit into kind of maybe some top line type of deductions that a business owner is able to take advantage of as that owner versus, somebody who receives their income via a W-2 type of status. So let's do this, because I kind of brought us into a little area, but when we start a little bit deeper dive into some of those topics. So when we look at retirement contributions and deductions, I talked already a little bit about 401k. And so the 401k contributions, that you can put in this year, it's $23,500 that you can, it's $23,000 you can contribute. You can contribute that either pre-tax or after tax, so the Roth 401k or the traditional 401k plan. And if you're over the age of 50, you can also make what's called the catch-up contribution. So that's $7,500 for this year. So that's a total of $30,500 that you could put into your retirement account. So the very first thing we tell people, if they have a retirement plan at work and they're trying to reduce their income, let's start looking at how much have you contributed to that 401k plan to see if you can actually put more money into it before the end of the year. Because once January the 1st clicks in, you can't take more money out of your paycheck for the previous year. So we have to do that this year. And that's what they call this above line deduction. So it's really just reducing your taxable income if you choose the pre-tax option, which means you control a little bit of those tax brackets. Did I cover that well, Joe?
Yeah, it's really important for these self-employed or closely held businesses. Also for them to be realized that you can't set up this 401k plan after January 1st. It has to be done prior, even if you're a sole proprietor.
Mm-hmm.
These 401k plans have to be set up in the current year.
Mm-hmm.
Missed opportunity at times for people.
Yeah. And there's some things again that you could possibly do next year, but if we want to, let's say a self-employed person, especially if they have maybe themselves and maybe a family member, and they're looking at setting up a 401k plan, the time is kind of running out for that activity. You got to get going on it fairly quickly, or you're right. The other area that kind of comes into this retirement area is the qualified charitable distribution. So we talked a little bit about about required minimum distributions, but the QCD over there on the left side is something that either Brian or Will probably want to go into a little bit more detail, because you both kind of mentioned it earlier. So what do you guys see or recommend on this side for clients?
Yeah, the QCD that qualifies taking money directly out of your retirement accounts, pre-tax accounts, and sending a contribution or donation to a charitable that satisfies part of your RMDs if you have RMDs that year, and it also then does not become a taxable withdrawal from your retirement accounts either. So those are two benefits from taking money directly from an IRA and giving it to a charity of your choice.
At what age can you take the QCD and give that to a 501c3? Boy, how's that for jargon? So,
I'm gonna 70 and a half, Mike. That's when you can start doing that. So
yeah. Well, and our RMDs are 73 now, right? So there's a little bit of a gap between the QCD when you can take those. It's based on the old RMD number of 70 and a half, which a lot of people, again, don't realize there's a difference between the two.
Yep. So under current law now, RMDs start for people that are turning 73, and then down the road, it's going to go up to 75. And so we're keeping an eye on that as well.
Mm-hmm. Okay. Good. Then there's IRA deductions, and that's basically again a scenario if depending on where your income is, if you're able to deduct a traditional IRA or not. But from a planning standpoint, trying to make sure that your AGI is at a certain level might be a scenario where you start combining some of these together. Your health savings account, which is a fantastic opportunity to put money away pre-tax and potentially have it tax-free when you need it. But that's another way to put some money away out of your taxable situation, but out of your paycheck, and keeping track of all your insurance premiums, especially if you and any insurance costs that you might have to use that as potentially a deduction if some of those costs end up being higher than your standard deduction in the tax year. So 6 boxes here, 6 different strategies, and they all kind of, if it could draw lines to them, they might all kind of intersect at one point or another. So, when we look at itemized deductions, Joe, this might be a good one for you to take a look at and explain, especially that SALT tax. I think a lot of us have become familiar with that, but maybe a refresher on that SALT tax would be good too.
Yeah, with the current law, doesn't allow anything more than the $10,000 deduction for state, local, and taxes. So that means state income tax through your W-2 is limited to $10,000. Same with the real estate taxes. So that's really a negative for us higher tax states. So one thing that is being talked about is trying to eliminate that cap of $10,000. I don't know if that will change or not, but you know, I think it would help some of our Minnesota residents for that to go away. Mortgage interest deduction, again, it tends to be for younger people. It's hard to you know, a lot of the older clients have paid off their mortgage or have a smaller mortgage, we're seeing. But that's an important deduction. Charitable contributions, again, you want to maximize charitable contributions. You want to figure out if you're going to have itemized deductions, that's when the charitable contributions are more valuable. If you don't reach in the threshold if you have no mortgage, it's hard to make those charitable contributions deductible unless you contribute a large amount of money or you bunch it up. Some years you minimize your contributions, and some years you double up, and that's a tool on how to make it more deductible. Medical expenses, again, we don't see them exceeding the 7.5% AGI unless somebody has a medical problem. So, or if they're in a nursing home, you know, those, you know, we have clients that it's amazing the cost of, you know, memory care and whatnot. So, yeah.
Yeah, I mean, that can be $10,000 a month just for the cost of a facility, you know, and that's just a lot of times, you know, it's just the cost to stay there, you know, and then you layer on top additional costs for care needs, you know, as well. But some of it's within that 10,000, some of it's not typically. So, you know, that's a different conversation really about, you know, kind of asset protection and what sort of, you know, strategies you might want to look at in that. But we see that frequently, you know, the one thing that's interesting that you talked about too here is the SALT tax capped at $10,000. You know, so a lot of people back in 2017 when they reduced the tax rates, because this kicked in at the same time, you know, then being, as Joe said, a high income tax state, Minnesota, where you used to be able to deduct the entire, you know, income tax that you paid in Minnesota off your federal return. Now it's $10,000. And so, you know, there's, again, a conversation if you're a business owner and you haven't started doing some pass-through entity tax planning around this, something to reach out to Joe about, because there might be some opportunities there, whether this goes away or not, to try to manage it a little bit better, you know. You know.
Yeah.
So what we're looking for, is there anything that you can deduct that's above the standard deduction amount? That's really what it comes down to, because we've had some caps, and the charitable contributions we'll talk a little bit as well, kind of going forward. Now the other area around the planning that I mentioned earlier was just kind of trying to manage your capital gains. You know, so if you sell and invest, let's say you sell a property, we'll call it investment property, so it doesn't get confused with your residence, which has a potentially different tax structure to it. But, you know, if you sold an investment property or a second home, you know, and you've got a $200,000 or $300,000 gain in that property, you know, then what can you do from a tax planning perspective to try to not pay 15 or 20 or 23%, you know, taxes on that gain, you know, plus the income. So, you know, what we tell clients is this is where you start looking at what else in your investment portfolio. Maybe it's some investments that you have had for a long time that have underperformed. Maybe there's some losses somewhere that you can harvest, and you can use that to offset some of those gains. You know, or maybe you look at, you know, your old tax returns, and we can do this very efficiently for you through through a program that we use to generate a 2-page summary report of your entire 1040 return. And we'll know exactly what your carryover losses are from old returns. So if you had losses that maybe you incurred in 2022, but you didn't use them in 23, maybe we can use them in 24, so it's a lot of planning that we can do around this. These carryover losses, or any losses for that matter, $3,000 of those losses can go against income. But that's it. So if there's only, $3,000, if you don't have gains, that's where you carry them on to the next year. And so if you've got some that are left over, could be back from 2008 when we had the Great Recession, they're still on your tax returns at $3,000 a year. That's a good time to start using those losses to offset maybe some gains, especially if you've gone through some sort of big transaction this year.
We did have a question come through the audience that relates to losses. So the question asks, can you speak to a real estate professional using depreciation benefits of investing in a real estate fund that's getting K1 losses due to the cost segregation of assets? So just for the audience, when you invest into real estate as a rental property, for example, depreciation is one of the things that you could utilize. Joe, are you able to talk to the K1 aspect of a real estate fund and losses within there to maybe offset other gains?
Yeah, that's not going to offset capital gains. It's going to offset ordinary income, but capital gains and K1 real estate losses are two different categories. So,
Okay.
Thank you.
So what I'm hearing, yeah, thanks for that too. What I'm hearing on that one, that sounds real specific to a person's kind of activities for what they do for a living. That would be a great example of maybe jump on a call with Joe and go through your scenario. If you're already working with them, or if you're not, we'll make available where you can at least talk to them about that case, but that sounds pretty unique to that person. Mm-hmm. So thanks, Joe, for answering it. There might be more information in there too that needs to be addressed. So, again, go back to the 22 tax return, see if there's any carry forward losses that might have come out of there. Remember, the stock market was down about 20%. The bond market was down almost as much that year. So if you're working with a financial advisor and they generated some losses, you might have a scenario where you have something there that you can really utilize. It's kind of the making lemonade out of lemon scenario for this tax year if you're on the other side of that equation this year. I think from the standpoint, when we look at charitable contributions, just for a matter of time, we talked a little bit about the qualified charitable contributions coming out of an IRA account, and Brian talked about that and the 70 and a half age limit as far as when you can start doing that. How much can you, and if you brought it up, Brian, I missed it, but how much could you put towards a charity from your IRA if you were so inclined? Like, what's the maximum?
I might have Joe answer that question. I don't have that number on top of my head.
Okay.
I believe it's 105,000 for 2024.
Yep. Yeah, it just went up. That's didn't mean to put you on the spot, Brian, but I know it went up this year. It went from 100 to 105. So you get a little bit of a bump up on there. So again, that's something that you might want to take a look at. Some people say, well, that's fantastic. That's way more than I would want. That's just your maximum. The other strategy that can reduce your income, besides doing these qualified charitable contributions or distributions to a 501c3, is maybe look at kind of what you give out in charities on an annual basis and try to bunch them all together. So like if I give $15,000 to the Lake Minnetonka Triathlon, which is a 501c3 that we use kind of as a funding vehicle for community charities, and I know I'm going to do that for 5 years, maybe there's an opportunity within this donor advised fund that I've got here to bunch all that together on 1 year, take a deduction and use that account to make my annual contributions to the 501c3 or C3s that are important to me. you know. So it's a really nice planning tool when we're in a scenario where your income especially has gone up a lot. You know, like maybe you sold a business some sort. Maybe maybe you had a big bonus at work, or you had some stock options that came to to expiration and created a lot of additional compensation for you. So, again, these donor advised funds are something that could be a real nice benefit. You also get the chance as a family to kind of decide how you want to give money away. It's kind of like having a private foundation without all the costs and headaches of a private foundation. So, do you guys have any other thoughts around either one of these QCDs? I know we've talked about the charitable contributions.
Yeah, donor advised funds, they're irrevocable gift. They also help with estate planning too, kind of held outside of your estate. So something that, again, as the son said, if it were to stay in fact, more people are going to need to be doing advanced estate planning, which was part of our prior webinar too. So a tool that helps from tax planning now, as well as estate tax planning for legacies. So great tool in specific situations.
And the other thing that we have in there, I know we've done this obviously over the years, is gifting appreciated securities. So if you're in a spot where you have some stock that's gone up over the years and it's gone up quite a bit, that might be something also that you want to contribute to a charity. You get the tax deduction at the value of the gift time, and they get to sell it Normally, that's what they do. They sell it right away, and they get the cash, and the charity can take advantage of that donation that you made through that charitable stock appreciation. You know, we used to do this a lot. I don't want to go too far into the weeds. We used to do this a lot for clients that were retired, because it was a good way to get rid of some of this appreciated stock. If you worked at 3M forever, or you bought NVIDIA 3 years ago, something like that, it's a way to do it. But we're actually telling clients more often now to actually look at the QCD, from your IRA, because they changed the tax laws around IRA accounts. It used to be in the past, non-spouse could inherit the IRA, and then they could take their entire lifetime to basically take money out of it, and they shorten that up to a 10-year window. So from a tax planning standpoint, you might be better giving more money out of your IRA account versus your beneficiaries inheriting stock at a step-up basis when you pass away. There's no step-up basis in an IRA like there is. So again, talk to your advisor about what might make the most sense in your specific situation. There's other charitable remaining trust. There's other things that you can do. I think it's probably beyond the scope of today's program, just because we have about 60 minutes here that we want to talk about taxes. But if you're looking at trust, you might want to jump into our estate planning series of webinars and learn a little bit about more how charitable trust could benefit you. We just had our first one that went really quite well a week or two ago, and we're going to have two more programs coming up before the end of the year on that as well. So how about gifting to the next generation? There's some really powerful aspects of gifting to kids, and all three of you can jump in if you see anything specifically here that might make sense for you to talk about. Top of my screen is Will. Will, is there anything here that comes to mind that you see frequently with clients?
Yeah, gifting is a great tool to help family members, if it's important to you, during times where you feel like they are going to appreciate it or need it the most. A traditional example is you wait until the very end of your life to then, facilitate any inheritance. But let's say you have children who they just graduated college, they want to buy a house, kind of the intra-family loan piece there. That you want to help gift them because they're at maybe an entry-level position, make sure that they are able to maintain a comfortable lifestyle, things like that. There's tools that are at your disposal that help with your taxes to gift to those you care about in an efficient way. So this is this screen shows a couple of different options here, but those first two, we see commonly to help families support their children in times of need.
And that other
Yeah.
box is the Roth conversion box where, again, the mom and dad maybe have a large 401k IRA. They've done some planning. They know they're not going to need it for themselves for their retirement. And then they're thinking about, okay, now when the children inherit mom and dad's IRA, we know Mike just mentioned that the rules have changed. So they only have this 10-year window to get all of those inherited IRAs paid all the taxes. But in a Roth conversion, there is no taxes due on inherited Roths when mom and dad pass away and the kids end up with a Roth. So something they are going to leave their kids a non-taxable investment account considered a Roth versus leave it in traditional IRAs or 401ks. They're leaving the kids a taxable account that they're going to have to pay taxes over a 10-year time frame. So that's a great, a great way to set up the next generation with a lot less taxes.
And the
Absolutely.
trust planning piece as well. I mean, a trust provides clear instructions for how there are maybe a restriction. So in the example that you don't want to have your children have access to all the funds right away, you can put in certain age restrictions where upon age 30, they receive 30% of the assets. Upon age 45 is when they have full access. You know, these are things that you could put in place as a legacy perspective. And it's important with clients of ours that we are a sounding board for their children so that they are prepared to inherit their inheritance and that they're able to manage it efficiently. So there's different tools, especially from an overall trust perspective, that you can help make sure that your wishes are fulfilled in legacy planning.
Yeah, absolutely. When we're doing some trust planning, really take a step back from that. We're looking at the estate, aren't we? We're basically saying, okay, how are we going to manage our estates? And there's so many great things that we can do to bring down the value of the estate. And you say, well, why would you want to do that? You know, but these strategies are frequently, not all the time, bring down the value of the estate so that we have less estate taxes probably owed on that estate at the second death, of husband and wife. So right now, just to give you a little clarity around this estate tax issue, because it's as clear as mud, but there's a couple of things going on. Currently, the federal exemption amount is very, very high. And so if you have $25.84 million as a couple, or lower, you don't pay any federal estate tax. Okay, so very high amount. But that is part of that sunset provision that we were talking about earlier, and that gets slashed in about half of where it is now. So, if you're looking at maybe it's 14, 15, 16 million, somewhere in that range, that's a drastically different federal estate tax. And remember, the exemption amount is that ceiling. Everything above that is taxed at the federal level at 40%. 40 above that amount. And I see Joe shaking his head no, and hopefully that number is right, but it's a horrible tax and it's due in 9 months from the date of death. And so it forces a lot of families to sell assets that they might not want to, or might be a bad time to sell in order to pay some of these taxes. Okay. So that's going to come back into play potentially for a lot of people in 2026. And then we have in Minnesota, as long as you're a Minnesota resident, there's an estate tax here. We're one of the few states that have our own estate tax, but the exemption on that is $3 million. And if you do some planning, to Will's point around trust planning, you can make that $6 million. There's what's called portability on the federal side. We don't have it on the state side, but what we want to try to do is take advantage of these exemption amounts, and these dollar amounts, 3 million or 6 million, don't have a sunset provision on them, and they don't have an inflation rider to them. They've been set at these levels for a number of years as assets have continued to grow. Farm values have gone up, business values have gone up, and remember, if you don't do your planning quite right, your life insurance could be part of this estate calculation. So we think it's really important that everybody has a personal financial statement and they know exactly what potential estate taxes they could be facing, or their beneficiaries could be, And then a lot of these gifting to the next generation strategies come into place. So doing a lot of talking, but this is something I'm very, very passionate about because there's so many things that we can do to help families today and in the future if we plan well.
Mhm.
So, how about from the standpoint when we consider, strategy where we're accelerating income when a lower with a lower tax bracket, so this is a scenario I think Joe and Will, could kind of look at when we have somebody that's maybe new in retirement or going to be new in retirement and they have an income drop. And so what sort of strategies might make sense to start pulling all this in together in a case study?
And on the left-hand side, you'll see there's that what's labeled low income years. This is what we call the tax window. So it's common in some situations that you're fully retired, you are in a lower tax bracket. Your required minimum distributions have not started yet, which is largely represented by those total tax line bars increasing over time. So it's a great opportunity to look at some tax planning. So what a Roth conversion does on the right-hand side is we're touching base here is you're accelerating that income. So you could think of your IRA or 401k, that money is going to be taxed at some point. Might make sense to pay taxes at a lower rate as opposed to letting it grow over time to be at a higher rate. So those red bars represent where you're increasing your taxes. But then the gray bars you'll see over time represent the total tax saved by accelerating that and paying it at a lower rate. So you might want to see, okay, what does that look like in terms of a lifetime savings for me? Well, at the bottom, you'll see there's a red circle around cumulative taxes. So in this scenario, we would help the client be able to save $176,000 less lifetime taxes that they have to pay. Okay, and by being able to put assets into the Roth account, which has tax-free distributions once you've met the requirements, and as a legacy tool, you'll see just to the right of that, the ending portfolio value for this client increased by $519,000 in that bottom right corner. So anytime we're able to help clients save money on taxes and increase their ending portfolio value to be able to do the things they want to do, from spending more to a larger inheritance and a tax-free bucket, these are win-wins from our perspective. Joe, anything you would add to the Roth conversion piece?
No, I like this example, Will. Unfortunately, so many times people wait until they wait until they're ready to start those R&Ds, and they miss this window to start these Roth conversions. Yeah, so that's why it's important to do this sooner than later.
Yeah, that's a great point. You look at something like this, typically this would be somebody that may be retired in their 60s, let's just say 65, and they're not collecting Social Security benefits yet. Potentially, they're also not in a scenario where they are taking required minimum distributions until 73. So they literally could take advantage of those, 10%, 12%, tax brackets with these Roth conversions. But if you wait till that 73, a lot of the mindset is, oh, just let it keep growing. It'll just keep growing, that traditional IRA, but then the taxes just keep growing too.
Yeah.
Well, and so talking about required minimum distributions, we obviously have those as well, and those kick in for people at 73 now and older. And we also need to look at, when you're looking at required minimum distributions, if you don't take them, there's penalties around it. It used to be 50%. Now it's only 25%, but a big tax penalty if you don't take them. And also, if you have non-spousal IRAs that maybe you inherited from your parents, as an example, that's what we see typically. There's potentially there's required minimum distribution on those as well, depending on when you inherited those accounts. So, and depending on if mom or dad was taking required minimum distributions. So it can get pretty complicated on those inherited IRAs. So again, I would reach out to one of us on this panel if you have any questions that are a little bit more in detail with that. But just keep in mind, standard IRA, traditional, not Roth. There's no required on a Roth. Standard IRA at 73, you have to start taking those distributions. Otherwise, you'll be faced with a penalty. Is there anything maybe that I've missed that you guys would want to cover? That's pretty much it, right?
Well,
Yeah.
the only thing I'll add is, the difference between, 401k versus an IRA required minimum distribution. So with an IRA, you have more flexibility on where you can take the account or the RMD out of. Each account has its own, but you could designate one IRA to do so. With a 401k, you have to take it out of that specific plan by the end of the year.
And then sometimes I get the question of how is that RMD calculated? You guys could address that.
It's a great question. Mike, did you want to go ahead?
Nope, I was just saying that
Okay.
does come up often,
Yeah. And so there's a couple factors to it. The first is your age. So there's basically a table that shows based on your age, this is the percentage that you have to take out. And you'll notice that that percentage increases over time. Now, the other big part of that calculation is what was the ending portfolio value or account value at 12/31 of the previous year. So now that we get to 12/31 of 2024, in early January is when your 2025 RMD gets calculated. So again, it takes the prior year-end balance, then it takes it to a chart based on a certain percentage, and then it turns it into a dollar amount. That's the amount that you have to take out by the end of the year.
Yep. And typically it's that first year is about 4%, give or take, of your IRA account balances. And to Will's point, you might have a little flexibility if you have money in a 401k, not as a business owner necessarily, but you might be able to delay that a little bit. But the biggest thing you want to do is just plan around these RMDs, because that can be a substantial amount of your income. And therefore, a lot of the things that we've talked about, you might not be able to do, as far as the Roth conversions. Now, your qualified charitable contributions, the QCDs that we talked about, those can be used to offset your RMDs, of course. So it's another strategy while you're in RMD territory. Do I give some of that money away to charity? So from a business owner standpoint, Joe, you work with a lot of business owners. So do we as well. Any end of the year tax planning strategies you would want to make sure that we address?
Well, it's just with the 401k, make sure their payroll is, that their payroll compensation allows them to maximize, for a SEP account or a 401k. So the retirement account and their wages work together. So it's important for them to plan ahead like that. So
yeah. I think this is a nice summary, whether you're a business owner or not, but a business owner especially, how's your income? I mean, if you go to Joe next April and you say, we had a great year at our business, our income was up, $300,000, and Joe knows about it in April, there's not much that he can help with from a tax standpoint. Yeah, we might be able to set up a profit sharing. We might be able to do a couple of things, but for the most part, that great year is locked in probably at a higher tax rate. So if you can get your bookkeeping in order, and Joe can help with that, and we can make some projections 10, 11 months into the year, here's where your income is. There's some definite planning aspects that we have control over that we can possibly implement, so reviewing your deductions with Joe or with whatever CPA you're working with. These profit sharing accounts that we've set up for our clients are really a powerful tool. We can work with those, or SEP IRAs kind of are in the same scenario. And I mentioned earlier the pass-through entity tax, and that's again, Joe, a way for business owners to kind of prepay they're through the business, pay that state income tax. So it does become a deduction for them because it becomes a business expense. I know I'm generalizing, but that's pretty close, isn't it?
Yeah, it works around the $10,000 limit for the state and local tax uh, ceiling.
Yep.
So business owners can actually take a bit of a extra state income tax deduction with the pass-through entity tax.
Mhm.
So,
Okay.
yeah.
Good, thank you. As we're concluding at the top of the hour here, we just think it's crucial that you're working with your CPA, if it's Joe or somebody else, and your wealth manager, if that's our firm or somebody else, to coordinate these tax strategies. Again, there's so many things that can be done now that can't be done later. So take some action on these. Start talking to your advisors about how we can plan around this. And if you have any questions, we're here to help. So I noticed one question that kind of came in here that I thought was interesting was around this salt tax. Do you think that that's going to get eliminated when they do the sunset provision on income taxes? In other words, is it going to go away because it came on at the same time during the Trump tax cuts? If Congress does nothing next year for 2026. Does, Joe, do you have some insight
Yeah,
into
I
that?
think it'll go away if they
Yep.
do nothing. But let's not hold our breath on that one. Depends on who controls Congress, I guess, right?
Yeah.
Those yeah.
That's going to be the big thing, isn't it? So in 2 weeks, we'll find out a little bit more about that and have a little more clarity around what potentially could happen. You know, another question that I see coming in here is, I'm going to stop screen sharing for a second, is around these donor advised funds. And we can get you some more information about them, but how do they work? And are there some limitations to them? And if you set up a foundation of some sort, it's a lot of expense for setting up foundations, and that might be right for your family to have some sort of family foundation. Donor advised fund is literally an account. There's a little administrative cost to it, but you can put money in, you can put a lump sum in, and there are some, and that money can sit there, at least under the current rules, that can sit there. There's not a 5% distribution rule like there is on foundations. And so and then we can manage the funds based on what's the appropriate amount of risk for this account. And then you can set up maybe a family meeting here at our office, and we can have family members come in and say, okay, mom and dad have contributed to this account. Where do we think we would like to share this wealth, through it? So it's really an important and a legacy tool, almost from a perspective of transferring what's important to you, maybe to that next generation. But
Yeah.
keep if you're doing one, just we'll keep an eye on it for you. But there's talk about changing some of the rules around how you have to do distributions on these accounts, but nothing's happened yet.
Yeah.
Anything else maybe that you guys would like to address, or any other questions that have popped up on the screen?
Nope.
Okay. All right. So, the one thing for the group who would like to stay a little bit longer, we do appreciate you being on this call. We're going to make available for people who signed up but were not able to join us, and for you who did join us, we recorded this webinar. We'll send it out to you, as well as a tax planning checklist and the ability to request a 15 or 30-minute sounding board call with one of the advisors here to walk through your particular situation. So we answered the Q&A. We do have some disclosures. We are a registered investment advisory firm. Joe is a tax advice and tax preparation service, so we do keep them separate. LPL is our custodian. and LPL doesn't offer tax advice or tax preparation services. We talked about Roths and kind of the things around Roth accounts, but if you'd like to stick around, learn a little bit more about our services, especially if you're not a client now, probably why you would stick around. We'll talk a little bit about how we work and what we really focus on. So, Will, I know you had talked about maybe you would like to talk a little bit about this segment of the presentation.
Yeah, and if you could do the full kind of diagram, I can talk through it too. So what makes 360 Financial unique than other firms? So with this diagram does a great job to show is what we call our life wealth plan process. It's what families rely on us to help reach their goals. So on the left side, you'll see what matters to you. That's the acronym that we use called FORM. So it stands for family, occupation, recreation, and money goals. These are the whys. So it's very important as being your dedicated planner that we understand clearly what is important to you so that we can help with the how. This is the recommendations, the strategies, and customized allocation to reach your objectives. Now, on the other side of the coin here is what you can control. There are things that we can't control, as we touched on through here, is the tax law changes, how they may affect your specific plan. So it's very important that we meet with clients on a continuous basis to update their plan and provide recommendations and reallocations as needed. Now, how do you manage things that you can't control? We have the 3 Ps here. So the first is philosophy. We feel that clients are best suited when they are surrounded by a professional team that is experts in this field. The second is planning. Your assets aren't intended just to grow. There should be specific purpose around each of those accounts and the planning around that. So that's why we are so planning focused. And the last here is process. So we make it a very easy process to get the plan up in place and on a continuous review. These are the 3 Ds. So you'll see the discover. It's initial conversation on your family's form goals. The design of your plan is aligning to what we need to do to get things in place. And the deploy. A plan is no good unless it's actually put into motion and continuously reviewed. So that's what the life wealth plan process is from the start to finish here.
Yeah, great summary of kind of what we do, and that sweet spot in the middle of what matters to you as a potential client and what we can control is really where our life wealth plan sits, and that's the strategizing about how do we get to the outcomes that you want for you and your family when you're going through this process. And what we have to do when we're looking at these form goals is really take a look at what are these impactful financial events that we've seen lots of times. I started the firm up 29 years ago this week, as a matter of fact, and these impactful financial events haven't changed much over the years. If you look at the left side, estate planning and your legacy, what do you want to leave behind? What does that look like around gifting and inheritance and those sort of things? We talked about that. What's your investment strategy? We just had somebody in here recently that said, my investments are a mess. I've got them at another firm and I can't keep track of them. I don't know if what's one over the other. I don't even know what the expenses are of these investments that I'm paying. So, these events around, the market's going up and down are one thing, but it's also how do you invest appropriately based on how much risk is a good level of volatility in your portfolios that you can live with. And that kind of ties into this family security piece. We didn't really talk much about college and 529 accounts, but those are interesting vehicles to use from a tax perspective. But there's all these other family security events, loss of a spouse, a health event. Brian is our resident expert in covering risk around life insurance. And it's very, very important, especially for our younger families, that these events are at least discussed and maybe there's a strategy that goes in behind them. Of course, retirement planning, we call the work optional dates. When is that going to occur? When can you decide that you want to keep working or not? And therefore, what can we plan around and focus? Tax planning, we just spent the hour on, and then business owner planning, which is part of what we just spent this last hour on. So this is the way it looks like for a client who's relatively new. It's not etched in stone like this, but it gives you an idea what the cadence is. Since there's basically 4 pillars to financial planning, we've got 5 here, 5 different areas listed, 6 different areas listed. We'll try to chunk it into different quarters so that we can manage it appropriately. Now you can accelerate this, but it might be, for example, Q1 that we're in right now. For somebody who signs up today, let's focus on your tax planning and your investment strategies. Okay, then second quarter of our relationship will start flowing, and we'll look at cash flow. We'll bring the expert in on asset and risk management and what needs to be addressed there. Then Q3 might be a deep dive into the retirement planning, depending on where we're at in that phase and that path towards work optional dates. And then Q4 might be a scenario where we just focus on your estate planning, your trust, your will documents, your healthcare directives, making sure that these sort of things are in order if God forbid something would happen to you. We have an investment strategy that we use with our clients. It's again something that we've fine-tuned, and we have a process where every other week 7 of us get together, we go through our investment strategy, but it's really focused on kind of 2 areas. We have a foundation to our strategy, and we have this leadership approach. And the foundation is, let's buy good quality investments, low cost, exchange traded funds, typically charge a management fee. That's how we get compensated for our services. And build this portfolio that aligns with the goals and the risk tolerance of that specific client. And then let's look in the markets and see if there's any opportunities, whether it's like semiconductors or home builders or infrastructure build out that needs to be done. And could we focus a little bit of the assets and the resources towards those areas that we think are the leadership areas of the markets that we could take advantage of? So it's really a 2-prong approach to this foundational piece of really high quality investments and this leadership approach to say, where is there some strength and a heat map of what type of investments would make the most sense for our clients to own.
In one of our most recent investment committee meetings, we had a very interesting chart that showed the top companies in 1980s by decade through 2024. And the most interesting takeaway from that is that all the companies that were listed as the top 10 in 1980 were not on the 2024 list. So it just shows that you need to be proactive with your portfolio, in our opinion, to make sure that your capital is being put to the areas where we could get strength, and you own strong companies that produce a lot of cash. That's going to be very important, especially as you get through retirement planning as well. So very important that you have an active manager, in our opinion, and that's what clients entrust in us as part of our service.
Mm-hmm. Yeah, especially when we're talking about multi-generational. That's a great point, Will, that you bring up, because the companies of yesterday aren't the leaders necessarily of today, or even the certain areas of I mean, this will date myself, but I know when the internet kind of became popular. Now we just assume the internet is just part of everyday life, but that was a huge growth area, and companies benefited from that growth, of course. And some didn't, some went away because of the internet. So there can be growth, or there could be decline, depending on what's going on in the world, especially around technology.
Mm-hmm.
So the process works kind of like this. For you who are new, we generally have what we call a fit meeting. Is our service on this life wealth process, our investment strategy, and our fee structure, does it align with what you need as a family? And if it does, and we decide to work together, and it's kind of a mutually beneficial, let's look to make sure that you're a good fit and we're a good fit for you. And we just move on to the next phase, which is this get organized, where we start bringing together the statements, your trust documents, your tax documents, do a deep dive into those areas to try to find opportunities. Then we put together the implementation meeting, where we just say, here's what we're going to set in motion, here's what we're monitoring, and here's what we're going to be doing over the next 12 months to get us to this outcome that we're trying to get for you. And then we just constantly review and realign that. And we do it through a service promise that gives all of our clients regular contacts on a regular basis, so they know exactly what is going to happen next, instead of them guessing when they're going to hear from their financial advisor. So, I think just from a time perspective, we've covered pretty much everything today. We covered a lot of the information on the tax side. I see here that potentially a couple of conversations are coming in. So we have, the ability for to help the clients out as much as possible. Sorry, I got distracted. A message came in on the webinar chat, but it wasn't a direct question. So we should be pretty good for wrapping this up, is my understanding.
Okay. Right.
Okay, and I did have somebody, I'm sorry, I had one person talk about donor advised funds, so we've addressed that as that already came up in the conversation. So hopefully we addressed it. If you still have a question on that specific client that asked it, just give me a call. So thank you, everybody. Great job, panel. I appreciate you all being here, and let's get a lot of planning done here before the end of the year.
Okay.
Sounds good.
Bye.
Thanks.
Thank you, Ron.
Thank you.